Okay, let's answer some questions from Sunday's Market Outlook. It is Wednesday, July 31st, early in the morning. Want to get this out. It's a Fed day. Okay, first one. I think walking through a financial model on Excel is more appropriate for a walkthrough, as you could easily demonstrate how the assumptions and inputs fit in the model. Highlight relationships between certain figures by breaking down the calculation of the output. Have a clear visual of the trend over time of some key drivers. I think that would tie it all together and would understand why an element is important to the valuation and the strategy. Yeah, I think the exercise of working through the assumptions would be important. You wouldn't need to build a model that is too complex nor to forecast. No, you just have to show how you would forecast maybe out 4 quarters on each of the line items on the income statement, and then show the relationships to the balance sheet, which wouldn't be too complex, but it adds hours of setup because you have to build it first, and then you have to walk through it. You're looking at adding potentially another 15 to 20 hours of work onto each company that I introduce. Over time, as I add staff, I think that's a valid thing to do. You just make a point by demonstrating through a model, and maybe that can be an opportunity to teach aspiring analysts a real-world practice when analyzing target companies. For the new format that I'm doing, I do quite a bit of that. As we go through revenues, as we go through expenses, as we go through assets, I say, well, how would we forecast this? And then I introduce, a way that we would forecast this. We would forecast these expenses by increasing it at the rate of inflation plus 300 or 400 basis points, let's say, something like that. So let's get some feedback on the new format, and then I'll iterate from there. Are you shorting IWM on the basis that the Fed takes too long to cut rates? You mentioned earlier in the video that the Fed should be cutting rates, and the data shows that they can act now, yet knowing their cautionary approach. They won't start cutting to at least September. Do you run the risk of the Fed cutting rates Wednesday and the short going against you? If the Fed cuts rates today, yeah, those shorts will go against me. However, they are low-cost shorts to have, and I needed US dollars anyways. So I do have a bit of a carry going on there, borrowing against the factor size, borrowing against the small size factor, and investing it elsewhere. I just think that if we look at the chart of small caps, given the high level of rates, given that I do believe we are in a sort of era of large firm capitalism. Small firms, especially that need some kind of data advantage, are at a significant disadvantage right now. Larger firms just seem to keep winning, and smaller firms just seem to be losing market share to larger firms, or having a hard time breaking into a space. So I think it's premature. Usually, if we think about a business cycle, with this being expansion, there's your slowdown, there's your contraction, there's your recovery. This right here, that is the small cap sweet spot. That's where they tend to outperform, is in sort of early recovery to about mid expansion. And then if we look at small caps, they tend to have this kind of performance, and large caps tend to have this kind of performance. They tend to really outperform in the later stage, with technology really outperforming in the later stage. So I just think that, if we're here, that is still, I think, a part of the business cycle where large firms would dominate. Also, because of the move towards data being a significant asset, larger firms have a clear advantage over smaller firms here. You still have financing costs that are very high. You still have some small firms that can only issue shares to raise capital. You still have, for debt, you have MRR plus the spread anywhere from 300 to 500 basis points for small firms. MRR is still 5.4, 5.5%. Even if you get a 25 basis point cut, that still keeps it over 5%. You'd have to have at least 5-6 cuts before it starts getting interesting for small caps. So the interest rate cuts must be well underway, I think, for small caps to perform. I think a lot of people got in that trade way too early. A lot of people just got tired of, oh my God, it's always the same group of stocks again and again and again. Can we do something different? And when an opportunity looked like they could do something different, the market really said, something new, something fresh, great. I think it was a little early. As a Canadian trading on IBKR, I can't find equivalent of 3-month T-bills to park my CAD cash. What do you use? For this, you're going to have to call their trading desk, I believe. I looked at CBIL ETF, but it has a 0.1% management fee. Yeah, you would have to... Canada does issue 3-month bills. There's also a lot of commercial paper out there, bankers' acceptance out there in Canada, which is fairly liquid, but not in large quantities. It's still a dealer market in Canada, so you would have to call IBKR and use their dealer desk for that, but you can get that done. For selling puts, does it matter if I sell a put with regular expiration date versus non-regular? Not really. No. Is this more important, or is managing DTE more important? I think if you're trying to target your days to expiration, that's more important. As long as the irregular dates, some have weeklies, and they're just as liquid as the regulars. So as long as they're just as liquid as the regulars, you'll be okay. For a beginner to manage liquidity for my short put position, should I keep the margin requirement in cash? Put it in a 3-month T-bill. Well, the nice thing with IBKR is it pays you interest on cash, about 125 basis points below what you'd get in a T-bill. But if we're talking a couple $1,000 or $5,000 or $6,000, it may not be worth putting it in T-bills only to liquidate the T-bill later on. It may be worth it just to keep it as a cash balance in IBKR, and you do get interest on it. Do Canadian residential REITs move closely with the Canadian 10-year? More like the 5-year, because mortgages in Canada, whatever term you take, 15-year, 20-year, 25-year amortization, are done on 5-year increments. So you'll get a 25-year loan, a mortgage that amortizes over 25 years, renewable every 5 years. Being that you basically have a 5-year fixed on your 25-year amortization, then you have to go back and get a 5-year fixed on your 20, and then a 5-year fixed on your 15, etc. It is tied more to the 5-year rather than the 10-year. Any good way to find the chart with Canadian yield curve on IBKR? For the Canadian yield curve, you'll go to Bank of Canada. I believe the Bank of Canada should have that for you. What beta do you use for portfolio management applied series? I think the default is 3 years. Yahoo Finance shows 5-year monthly. Schwab shows an entirely different number. I want to make sure I'm using the same as you when thinking in dollar beta terms for position sizing. That's not important. It's not important that you find just the right beta. All betas are estimates. 3 years is your best guess based on the last 3 years. 5 years may be different. 10 years may be different, but not so different. But they will be different. They'll be different to some degree. Beta is a statistical measure, so it has variability. From day to day, your beta won't be the same. So it's an approximation. So being that it's a best guess, that it's an approximation, we just want to get close. The important thing about dollar beta is if you have a certain number for dollar beta, it's probably wrong. The dollar value would be right, but the whole beta thing would be the best guess. It's not going to be an exact number, but it does give you some idea of how far off the zero line you are with dollar beta, and if you want to reduce risk, you just have to bring that number down. Again, with offsetting positions that are the best guess of what the dollar beta would be on that side. So I give this example that even though beta isn't giving you an exact number, think of it like a broken scale. You can get on a broken scale and it won't tell you your exact weight, but what it will tell you over time is your change in weight, right? On TLT, if we assume 3 rate cuts by the end of the year, price target 106 from Alta Vista Research, is there any downside in setting 93 put to fund 93 calls, both at say 100 to 200 day expirations, or even just buying 93 calls? The 93 put won't pay for the 93 call because let's say the TLT is looking like this and you're going out 100 days. Options are centered around the forward price, not around the spot price. So if you're going out all the way to here, the options are centered around this forward price. That is the 0.5 delta up here, which might be $98. So you might sell a 93 for, let's say, $2 and find that's the put. I'm just making up a number here, okay? Let's say you sell the 93 for 2. With interest rates at 5.5%, this will be based on a SOFR rate, 5.4, 5.5%. You might be at maybe $350 because it is the $93 that's increased at 5.5%. It might cost you $350 for the call. So you're not going to get a zero cost option. You'd have to go maybe to the 96 puts to finance a 93 call. Right, so you'd have a leveraged synthetic. That is a leveraged synthetic, but you could do that unless you're not that interested in funding 100% of the call. Then you would be paying something for the call. You bought ABR calls at strike of 17.50. That's a break-even point, approximately 25% increase. Are you planning to exercise them or sell the calls until the stock reaches the break-even? I'll have convexity up to January. I don't need all the way to January. You just buy more time than what you need. I really only need, we have earnings on Friday, and I think we might get a rate cut today. Might, if they have courage. But certainly for September and then again at the follow-up meeting, I think you're going to get 2. I just need a couple of rate cuts. I just need the 10-year to print under 4%. That would increase the value, because ABR is financial assets. That would begin to increase the value of those financial assets. ABR could trade at a premium in anticipation that a lot of those bridge loans can find their way into the GSE. It would also immediately begin to lower their funding costs, which would begin to widen their net income margin. So their book value may be $13 now, but you get a 10-year under 4%, you get a couple of rate cuts, you could easily see that book value start to increase $13.50, $14.50. So that's all I need by September is an idea that maybe we're at $14.50 or $15. ABR will trade at a premium. And if ABR is at 16 at that point in time, those 17.50 calls are going to be worth a lot more than what I paid, double to triple of what I paid because I bought them at a fairly decent price. And I did fund them with some puts, so I'm not too concerned about it. Please explain the IV on the TLT screen that you do. Went from 49 to 65. What does this mean and why does it matter? Because we want to sell puts when premium is high. But how do we know when a premium is high, right? We can't compare stock versus stock. We can only compare for the stock to itself at some previous point in time. So IV does this kind of stuff, you know, over time. Well, if we're here with IV, I want some number that gives me some idea of where it is. So if we rank these all in order, let's say that we make a list of these. You have the top 1%, the top 2%, 3%, 4%, 5%, etc. IVP is the implied volatility percentile. So when we say that something is at 65, that is the 65th percentile. And I give you 52, 26, and 13. So if 65 is under the 13, that is saying in the last 13 weeks, the reading we see on implied volatility is higher than 65% of all the other readings. The closer that is to 100, the more we know that in the last 13 weeks, premium has never been better, right? So if this is suddenly 100, we would say in the last 13 weeks, implied volatility has never been higher. It's never been a better time in the last 13 weeks to sell premium. right? And then same with 26 and 52. It just gives you an idea of where it is relative to where it had been historically for itself. On your Lamb Weston, have you considered rolling those deep ITM 7250 puts further into the future? It will depend on where it happens to be in time. If I see that there is an ability to do that, that's fine. But they're so deep in the money that rolling them might only give me a pickup of 20 cents. That's not worth it for me to roll them for 10 cents or 15 cents. But, if Lamb Weston has a nice run up to, let's say, 65, 66 by expiration, and I can pick up, 80 cents to $1 by rolling them, I'll roll them. But right now, the pickup in roll would be so very little as to say, who cares? I'm not that interested. So for things like that, you can let the market tell you what the best strategy is, as opposed to trying to guess what it would be. When you say you have a short ES position and construct a long extension portfolio, do you consider the beta decomposition in different factor exposures? No. Again, all this beta stuff, even smart beta, even factor, the betas you get on your different factor exposures, those are all best guesses. Based on a statistical process. You have a bunch of observations and you say, well, what is my beta, right? So you see over time, well, I see different betas. Like if this is, beta up to 1.5 and down to 0.8, over time I've witnessed different betas. There's been time where the market is doing a lot and my stock does almost nothing, right? So over time you see just a lot of betas. Well, it tends to form some type of distribution, so your best guess as to what beta is the middle of that distribution, but it has variability. You change the look back period, you change your beta. And what we're trying to do is predict the future by using history, saying, well, how will this stock behave in the future? Well, it'll behave like the last year. Somebody will say, no, it'll behave like the last 3. Somebody says, well, let's take out all the variability, it'll behave like the last 5. Well, those are all just guesses. Beta is just a guess. It's because it's not deterministic, it's statistical. Whenever you have something statistical, you are in the middle of a distribution. You have a 50% probability that your beta will be higher than what you think it is, and you got a 50% probability of your beta being lower than what you think it is over any given future period of time. So if you say my beta on my stock is 1.2, over the next day, it might be 1.8, it might be 0.3, right? It depends on the variability of the beta. The more stable a stock is, the more predictable its cash flows, the less risky its cash flows, the lower its beta will be. And the lower the volatility in that beta will be. But beta, when we start looking at things like this, it's enough to get close. 3 years, that's pretty good. Monthly observations, maybe even weekly, that's pretty good. And if you measure everything with the same broken yardstick, the one thing it will tell you is which one is higher and which one is lower, even though it won't tell you the exact number. So these are all measures to be used in a relative sense, not an absolute sense. Ahead of the Fed meeting, 170 put on DHI, 16 of August, break even 166.50. Would you move out or stay in? The Fed is either going to cut or make a very clear signal that they're going to cut. I don't see the interest rate sensitive sector selling off on this. I think if we don't get a cut today, we're going to get a clear indication that the cut is going to start in September. Either way, whatever's being priced in, 3 cuts basically if you look at Fed funds futures. If in the press conference 3 seems to be under threat, which I don't see Powell answering anything about that. I think Powell's answers will be, well, we will see as things come out, but we're getting comfortable, I think is what he'll probably say. That if we're thinking about sensitivity to interest rates, if you're thinking the price is going to be supported by sensitivity to interest rates, I don't think that's going to disappoint. I don't think that would disappoint. But we live in a weird market. GM, great earnings, sells off. Starbucks, bad earnings, it goes up. It goes up on missing. It goes up on sales being down 1% in North America, 14% in China. It went up like 5% after hours. So who knows sometimes from report to report how the hell the market interprets some of this stuff. I've seen reports sometimes where you think there's every reason to sell and we rally hard. And then times where this is really good and you sell off hard. And other times where that's good news and the market goes, well, I don't know, maybe. And just goes sideways all day long. It's like, okay, because it is a probabilistic world with a distribution. There are times when good news means good news. There's times when good news means and there are times where good news means, oh my God, get out of my way, I'm running for the exits. Who the hell knows? Who the hell knows, right? So when I say all we can do is play probabilistically, we know that this is interest rate sensitive. If interest rates go in the direction that would be supportive of housing, all we can say is, well, it would be the direction that would be supportive. But what the initial reaction will be versus what the extended reaction will be could be two different things, could be the same thing, could be no reaction, could be the wrong reaction, could both be the right reaction. Middle of the distribution should be supportive, but keep in mind, there is a distribution. Do you include, or would you include at some point in the future, a section on financial planning and wealth management type of stuff in the applied course? That's not my thing. Wealth management, asset management. Yes, wealth management is a nice way of saying relationship management, because that's really what you're managing is the relationship but not the assets. The sponsor will tell you how wonderful you are and you're the best person they've ever met and you're smart and you're intelligent and good looking, and they get your money and they'll get anywhere from 75 to 150 basis points. That's the sponsor level, right? And then they'll give it to asset managers, so you'll be in all these different funds. That's generally what they put you into funds. And here you'll pay management fees as well. So you have a layer of management fees here. You have management fees over here. So this person over here, right? This person over here has got to be nice beyond belief. That's wealth management right there. It should be a course on how to influence people, because that's wealth management. This is asset management. This is where I live. Down in here is picking assets to invest in. Relationship management, I don't know that I would have been very good at that, because I'm too practical. I get to the point. I don't spend a lot of time saying, how's Denise? She's in college now, isn't she? Oh, she's so smart. She takes after you so much. You see that? That's wealth management. So kind of not my thing. Touched on it in CFA level 3. Yeah, but I think expanded material would be helpful, done by you, done by somebody else, but not done by me, because it's not my thing. It is a different thing altogether. CFA and most of finance really breaks down into two big categories. You have security analysis, right? And you have asset management. That's really the two big fields. So when you start with a CFA program, you say, am I going to go into analysis and into research and produce that, and that is my output that I sell? Or am I going to go into asset management and manage portfolios and earn returns above the benchmark, and that's going to be my income? Now, there are some wealth managers that will manage assets directly, but that is rare. That is rare. Usually your wealth manager is your relationship manager, so probably not. I work in wealth management and I use a lot of the CFA concepts, but at the same time, we can't spend a ton of time doing deep dives and rely on third-party money managers and research. Yep. I'll also be interested in some courses that expand on the performance measurement money manager selection aspect. That's the one thing I think for money managers that would be important. You touch on that in CFA level 3, is investment manager selection. But you just touch on investment manager selection because the CFA designation is what's called a generalist designation, not a specialist designation, a generalist. It's meant to make you a generalist. So when we talk about investment manager selection, you go, I'm aware of the criteria on which you would evaluate a manager on. But I am not aware of how that process works. That's not CFA's job to teach you how to do it, only that it can be done, and here are the broad methods by which it can be done. Now, good luck. And that's it. So no, there's really not a lot in CFA for this. They're trying to move into that area, but there's already a designation for that that I would probably say that, there's the CFP, the Chartered Financial Planner. That's where you're going to get all of that stuff, and that's just not my thing. I've never went the whole pathway of the know your client, build relationships with your client, financially plan all their, here's your insurance needs, your gifting needs, these needs, though. That's just not me. So probably not. How do you know if an option has good premium? You take the premium and you divide it by the capital requirement that you need, and then it's 365 over, well, how many days to expiration is this? 40 minus 1, it'll give you a percent, right? And good premiums are annualized 55, 60, 65%. Those are nice. Annualized at 25 or 30%, that's really tight. You better have an underlying whose implied volatility is less than, let's say, 15% at that point. So that what you're doing by doing that is you're saying, look, I want to earn a return. I want to generate income, but I want really, really low risk in doing this. So you're going to choose underlyings that have very little risk. And the lower and lower and lower the risk, the closer and closer you will get to a risk-free rate on the annualized premium. Have you made any changes to FCX? Nope. And your position in Enbridge? Nope. Also, why are you planning on holding ON if you see it as a risk? Well, look, I see everything as a risk. Every equity is a risk, because you could be in cash. So the moment you take on risk, or you move away from cash, you're taking on risk, but no risk, no return. Yes, it's a risk. That's the game we play. We're in the game of risk. Rookies think we're in the game of return. That this is going up, this is going up, this is going up, this is going to the moon. Buy this, buy that, buy this. I don't look at it that way. It's a game of risk. What kind of risk exposures do I want? On Semi, I think, has a good substrate. It's a good company with a good history of performing well. Well, I shouldn't say a good history of performing well. They did take a big $20 hit about a year and a half ago. But overall, I feel good about the company. I know the company. I've gone through the 10K. It's a risk I'm willing to take. If I'm not willing to take any risk, then I'd be in cash all the time. So yes, your statement, if you see it as a risk, I see everything as a risk. That's the point. If you start looking at the world in terms of risk instead of return, and you manage risk, return will take care of itself. Don't manage your return, manage your risk. Return shows up. Return is what shows up when you manage risk well. The economic calendar daily FX URL is no longer available to U.S. residents for 2 years now. Clear the cache on your browser. I don't see that. How could it not be available to U.S. residents? That seems extremely odd. For accounts with less than 100,000, sometimes it can be tough to use a laddering strategy with options because there's also a need to diversify. I agree. From your experience, which strategy do you think is better? Waiting to see if the stock drops to the bottom of a target range, even if it means possibly missing out, or jumping in and starting now? So this is the importance of having a watch list of underlyings that you're interested in. If you only have 2 or 3 names that you're watching, or even let's say you have 5 names that you're watching, When it comes time to selling options, you're looking at selling on these 5 and you're saying, well, should I do it now or should I wait? So that you are basically putting a strategy onto an underlying that may be inappropriate at that time. To everything there is a season, right? Let's quote some Psalms here. To everything there is a season. So if you have a list of underlyings, that's 20 to 30 long, out of this 20 to 30, my experience has been that some 20% is available each month. So you're going to get 4 to 6 that are in the position where you say, okay, now's where I would sell a put. And you sell a put. So a good example I've given before is Oxy. I was selling 60 and 57.50 puts on Oxy, and it ran up to $68 for a while. Well, it was off my list. It moved out of the house because I wasn't prepared to start moving my put up on Oxy. And it came back down to the $60 mark. Well, now it's back in the house, right? But it was out of the house for a couple of months. That's okay. I have lots of other stocks. So if you think that my theta sleeve is going to be about 50,000, then that's what's fixed over time. And maybe this month it's these 3. Maybe next month it's these 2. Maybe this one. As long as I'm consistent in generating the income I want off the 50, it doesn't matter to me what underlyings I'm using or not using. The one comment I hear is, well, if you would have just bought Oxy, you could have had it all the way to 68 instead of selling just these puts. Yeah, but if I put money into this, then I wouldn't have been able to sell puts on these guys. The point is, I'm using my 50 or whatever theta sleeve I have, I'm using my 50,000 efficiently and effectively. Yeah, I could have just bought Oxy and rode it up, but it wouldn't have been as efficient a use of the 50 as selling puts on stocks that I don't mind owning if I do get them put to me, but selling them only when they are in the right point where I do want to sell them. Rarely do I chase a stock up. Sometimes I do. Like TLT, I'll keep moving those puts up. You get a rate cut today, or you get a hint of a rate cut in September, TLT starts finding a new home around 94 to 96, maybe 95 to 97. I will move my strike prices up because that's an easy thing to figure out because it is rather mathematical. Why does ABR use the unpaid principal balance to calculate assets on its balance sheet, but then use the average carrying value to figure out revenue in the income statement? Well, your asset is what's owed to you, is the unpaid principal balance. I mean, you can't overstate the asset. That is the asset that is stated. You have to use that. Average carrying value to figure out revenue. That doesn't ring a bell to me. You might be reading something or assuming something there, or misinterpreting what's being said there. It doesn't ring a bell to me. No, that doesn't ring a bell to me at all. At the beginning of sector studies videos, I'm not really sure what I'm looking at, as I am not familiar with publicly exchanged financial instruments. Oh. Can you explain what it is you walk us through and why it's important? I assume that you know what a stock is. I mean, I make the assumption that you at least know what that stuff is. If you don't know what that is, then I would recommend whatever broker you have. They have an education center. I would go to their education center and watch their introductory videos on everything. Here's a stock, here's a bond, here's an ETF, so that you have the vocabulary and the definition. But I do make the assumption that you have some experience in knowing what a bond is, what a stock is, what an ETF is. I can't start from zero knowledge for this. So there is some expectation that you are aware of what some things are. I see screenshots of lists of industry groups, usually followed by a table showing new names for labels, and I'm not sure I follow the why. So you have GICS, which just gives you, every company has a code that tells you what sub-industry it's in. But the GICS classification system does change from year to year. So when you're looking at that screen of what the new names will be, that's because when I did the video, the change in GICS was still going to take effect. So I was basically just saying, here's the GICS now, but let's keep in mind on this date, as of this date, it's going to change. That this sub-industry is going to move over to this sector. So the big move was real estate being spun out of the financials. Mortgage REITs staying in the financials, but all of the REITs moving out and becoming a new sector called real estate. That's a big deal. So that's all that is. What key factors do you consider when deciding to invest in a stock? You tell me what sub-industry I'm looking at, and I'll tell you what factors I would consider. There is no one short list. Do you focus more on financial metrics like PE ratio and earnings growth, or do you prioritize other elements such as industry trends, company management, and macro? It depends. I know that seems like the go-to answer when you don't have an answer, is it depends, but that is the answer. It depends. Sometimes it's a good story. So something like AT&T, lots of debt. You're going to look at some numbers, you're going to say, nah, where it is right now is, it's a big company. It's hard to change these things. I don't like the debt. You need a story. What's management's plan? What is management doing? What's exciting? What's new? The idea that they recognize that the debt should be lower is a big deal, because going forward the debt will get lower, which means their credit risk will get lower. You get an upgrade on their bonds, you will have a boost in the equity price, because if the bonds are less risky, that makes the equity less risky. The equity will always be riskier than the bonds. So if the risk of the bond starts dropping, the risk of the equity starts dropping, the price goes up. Sometimes it's a good story, because you'll look at the ratios, you'll go, these are the ratios that have been in place for the last 10 years. Nothing exciting to see here. It's the story about the future, and sometimes it is the numbers. For some companies, it is looking at the numbers and seeing if there has been an improvement over time in those numbers. It depends on what you're looking at. Please explain the interest rate differential in US CAD. The most common way that currencies move in the short term is interest rate differentials. In the long term, it's something called relative purchasing power parity, which is kind of like an equilibrium position. So what it says for two currencies is, let's say this is the US and this is the CAD, and we're looking at price levels. And we see something in the US that we could buy for 100, and that same package of goods in Canada is 140. Purchasing power parity says the exchange rate should be 1.40. In other words, take your 100, convert it to Canadian, and you buy the same package of goods. Purchasing power parity, right? But in the short term, you have all sorts of deviations in both directions in the exchange rate from its equilibrium point. This is usually due to interest rate differentials, depending on what two currencies you're looking at. That's domestic minus foreign. And the wider the differential, money will flow to the currency with the higher interest rate. Now, it's not the differential itself, but the direction in the differential. So if you expect the differential to widen, the higher yielding currency will strengthen. If you expect the differential to narrow over time, then the higher yielding currency should depreciate over time. So it is the difference in the interest rate differentials. Canada has 2 rate cuts on the US. The market is betting that Canada will get to 3 rate cuts on the US. That the differential will widen. I don't think it will. That's what I'm getting at. That's short term. Now, that's not precise. In no way is that precise. It's just usually the tendency for currencies to behave that way. We live in a probabilistic world. We make probabilistic bets. So we want to play the odds in our favor. This is closer to being in our favor in terms of how you would make a forecast. CAD or CAR.UN call will give your right to buy. So how is it selling? No, it won't. I sold a 45 put. I sold a 52 call, 70 cents. Which means if it is put to me, I pay 43. My average cost will be 44.30, and if it's called away from me, my average selling price will be 52.70. I sold the call. Is the analysis process shown in company analysis the same for a professional analyst, or is it more of a retail investor approach? So the approach I take, if we look at institutional versus retail, they walk the same road up to a certain point where the retail investor says, I'm good, and the institutional says, no, we must get much more precise. We need a price target. We're going to forecast every line item. I got questions for management. They go further, whereas for the retail, we're good. We don't need to know this line item and that line item. I have a good idea of where we are, and I think the stock is undervalued on a broad sense. We don't need to know how much. I don't have to calculate a target price and say, okay, here's my price target. I don't need, as the retail, it's just way too much work. The institutional investor will go further. So is it the same process? Up to a point. The institutional will take it a lot further than that. You might have repeated several times, but I have a few questions on the applied level series. What is the price of the applied level for CF enrolled candidates after August 1st, 320? The same price, doesn't change. Would there be any difference between the access to the content if I bought before August 1st? Yes. New modules that I add. So, for instance, new positions will start in September. That will only be available to those who bought before July 31st. After that, this has a monthly fee. And then there are going to be sub-industry modules as well, where let's say in a particular sub-industry 5 to 10 stocks are followed. So there'll be an introduction to all of these stocks, and then every quarter there'll be an update to all of these, and then every week a short video on any news that affects this sub-industry and trading setups. Hopefully some of these will have options. Maybe there'll be a long short trade within there. Maybe there'll be an option, let's sell calls on these ones, let's buy puts on these ones, or sell puts on these ones, whatever. I don't know. But these would then be recurring revenue as well, along with new positions. But if you're in before July 31st, then you have the all-in, the all-in subscription price. You wouldn't pay for any new modules that were added on. Thoughts on whether to change some or all of my SPY ETF to an equal weighted ETF, as it has had such a run up and I feel some of the companies are overvalued. Yeah, I can see that. If somebody said I want to do that, I would say, if you're feeling that the bigger companies, the top 10 that have 35% of the weighting, if you feel those 10 are very overvalued, then yeah, you probably would want to move to equal weighted. I appreciate no one can know what will happen for sure, but your insight is always valuable. Also, as a Canadian, how much of a portfolio do you think should be invested in the U.S. stock market? I don't find the Canadian market that interesting to begin with. So for me, it's always been, the majority, 80-90% in the U.S. In live Q&A today, you said yield curve inversion is caused by short rates going up, long rates going down, because longer term market doesn't think rates will stay high. Or they believe that inflation will get crushed, or that growth will get crushed. So now that the yield curve is uninverting, shouldn't the long rates not change much, given that the market already priced in that? The long rates aren't changing that much. And last week, the 30-year, I think the 20 and the 30 didn't change at all. So what you have is, let's make the dividing line here. Here are your money market rates. There's the 1 year. The 1 year is actually dipping. The 2 year is below that. So previous to that, you had, from the 1 month out to the 1 year, fairly flat. You had a 2 year that dipped down, and you had a curve that kind of did this. There's your 2 year. There's your 10 year. If you take the 10-year minus the 2-year, you have a negative number. Well, your 2-year is starting to dip now, but your 10-year is not coming down that much, such that you're getting something like this, where the 2 to the 10, you're almost at a flat point. You get a Fed that signals rate cuts, you get a 2-year that drops more and a 10-year that doesn't, you might start to get, although very low basis points, some upward slope in that capital market curve. This is your capital market curve. This is your money market curve over here. The inversion in the capital market curve will uninvert, but in the money market to capital market curve, in other words, the 3-month to the 10-year, that's not going to invert until short rates start coming down significantly. I have a question regarding portfolio construction. What is the sizing percent in your portfolio given your conviction? Depends. Usually quite small. I don't really take on big size unless I really truly believe in it. Then I'll break my rule and I'll make it 5%, 6%, 8%, 10% of what I have. Do you set limits on investment themes given that some might be correlated? Yeah, I try. Yeah, I try not to be, too much in a particular theme. Like all beta, not really. All duration, not really. Combination of beta and duration, yeah. So I do have some stocks that have nothing but beta. I do have some items that have nothing but duration. I do have some stocks that have a duration component. Utilities and apartment REITs are very interest rate sensitive. But I can't think of a better winner right now. Rates are coming down. So equities that have a duration component to me seem like obvious winners. Seems like, nickels on the road. May as well pick them up, right? You mentioned SOMA reduced 3.7 billion, but Fed balance sheet reduced 2.7. Does it mean that the Fed is actually easing its quantitative tightening? No, it just means that, from week to week, there are other accounts and other things going on. That's all it means. $1 billion is nothing when your balance sheet is 7.3 trillion. 1 billion is a mosquito bite. You wouldn't even notice it if you weren't paying attention, right? It's insignificant. But all the accounts on the balance sheet move from week to week. This is up a little, that's down a little. So there's more accounts than just holding securities, right? Short-term options lead to capital gains losses in the U.S. I'm not familiar with how the U.S. would treat it for tax purposes. Are they affected by wash sale rules? It could be. They could be. Sometimes they depending on how you use them, they could invoke a deemed disposition. So let's say you have a stock that's at $100, and you don't want to take the gain on this thing, but you don't want to risk it dropping. So you sell an $80 call, and if it drops, you'll make the money on the call. At least this is what you're hoping. Because you sold so deep in the money, and the delta is so high, you have 100 delta here. If the delta on the calls was like 0.9, you have 90 delta over here. Being that these are so close, 100 versus 90, if you were ever audited and somebody went through line by line, they might say, that's a deemed disposition as of that date. That's not hedging anymore. You're almost engineering a risk-free position, which makes that a deemed disposition. Every country has its own tax rules. When it comes to the U.S., I don't know what the tax rules are because I've never filed in the U.S. I've never had to. Where did Paul Jacobs say the 1 billion share target was for this year? In reading the transcript, that target seemed like the general goal with no timeline attached. He did mention that there was some room left in the stock repurchases that were announced, that they were sitting at 1.14 billion, that their goal is to get sub 1 billion, that they do have some room left, and that if things don't change, they will continue to use share buybacks in their arsenal. Nothing is changing. I see no reason why they wouldn't issue another share buyback this year and do it. So maybe it was me, listening and reading between the lines, saying and projecting out, saying, well, you're not going to get the respect. The market's not going to give you the respect. You are going to have to buy back shares, and being that you want to get under $1 billion. I see no reason why you wouldn't do it this year, because I'll tell you right now, GM, market is not going to give you the respect that you deserve. It's not. Will this new format be used to replace previous 10K walkthroughs you have already done? I might. There's a couple that I think I could revisit and do better. I don't know if I'll do them all, but I might. But going forward, this would be the way it is done. Where are we on time? Because I gotta keep my eye open for where we are here. Excellent update as always. In your upcoming financial modeling module for the Applied series, will you cover modeling fixed income securities and bonds? No, just equities. Thought it might be useful, especially as some low rated credit may be looked at favorable versus a company's equity. Well, if we get to a company that has an amount of debt, in doing this, you got to look at the debt. You have to look at the debt. And if we find that the equity is too risky, then there's always the debt that you can look at. But sorry about all this beeping. Things are just 8:30. You have economic data that's released, and I'm on all the mailing lists, so in they come. Let's see, beginner and macro. Crude stocks changed. Why is a draw of 3.71 million when compared with a draw of 2.5 better than forecast? Not better. It's a larger drawdown than forecast. So if inventories are dropping faster than what you think, that should be supportive of price, right? So inventories are dropping. That means not as much supply left in inventory. It should be supportive of prices. So when we say that something is good or bullish, it means for price. We wouldn't say, oh, that's bullish for inventories because they're disappearing. It's everything translates into price. So if we're long oil companies, or if we are long the oil price through some contract, that's what it means. As I thought, a lower drawdown or even a build indicates less use export of resources. A lower drawdown would indicate that, therefore negative. We're not talking about the economy. We never say what's good for the economy. It's always what's good for the asset price. So if we're looking at well, let's have a look at what happened yesterday. Israel hit a Hamas target in Iran. Iran vows revenge on this one. How dare you do it in our country? So oil prices go up. Now, we don't say, oh, that's negative for the economy. We say that's positive for oil stocks. That's positive for oil companies. It's positive for the oil price. That's what we say. So because we're in this game to make money, we're looking for where asset prices would increase. Sometimes a threat to the global economy is what you need in the asset you're looking at for price appreciation. Okay, so I've already talked about that. Any opinion on the earnings of Stellantis? Net income down 48% quarter on quarter, 1.3 billion restructuring costs. Well, they got a lot of brands. What did they have? 14 brands. The belief was they were going to get rid of some of those brands. They didn't get rid of any of those brands. They want to give them all a chance to perform. Now, on the last interview I saw on Bloomberg, the CEO is saying nothing is sacred. If brands have to go, brands have to go. It's believed that either Chrysler, Dodge, and I think Maserati are on the list of things either to be killed or to be sold off. Did you see the restructuring as beneficial as it could prove the second earnings this quarter? Unless they start selling off brands, unless they start closing things down, I don't think so. IJS or IWM considering rate cut environment? Don't know what that means. What's your view on Berkshire post Buffett? It would be like saying, well, what's your view on Apple post Jobs? It's hard to predict. At that time you would have thought, well, Jobs was pretty much the innovation engine in terms of his brain and his creativity and what he could conceive of without him. Where the idea is going to come from, and they've kept coming. So it could probably still continue on. Only results will tell. Although you are selling the COPEX puts in the money, I assume you expect them not to be put to you. That's why I sell them. With inventory spiking in July and demand slowing down, it is a matter of time that copper loses the $4 mark. Not really. You're forgetting the role of the US dollar. You start getting a Fed that cuts rates in July or signals that they're cutting in September, that US dollar starts dropping. And since copper is denominated in US dollars, it will start rising. Do you have a target price in the short term? Not really. Also, I saw that you stopped selling puts on the FCX and changed to COPX. No, I laddered down on FCX because it's my favorite one. I'd like to own that. And then I decided to bring in a portfolio of copper stocks. So that's why I use COPX. Yeah. I'm a full subscriber. I was wondering if you were planning to do soft commodities in your sector studies. As long as it lines up with a company somewhere. Yeah, as long as it lines up with a company somewhere. Because just playing futures, playing commodities, these are straight up or down bets. There's no income stream with it. There's nothing exciting other than straight up or down bets. But a company that's involved in it somewhere, then at least I have something. I have some production system that generates some cash flow beyond just straight up or down bet. Mortgage periods in the U.S. are 15 and 30, correct? Is there a more favorable tax system in the U.S. for a greater percentage of discretionary income to end up in venture capital funds? I don't think so. Why are Canadians stuck with 5-year mortgage renewal rates? That's the way it works. That's a good question. I look at that too and I say, why can't we have a 30-year fixed in Canada? Well, why does it have to be this every 5 years you come back and beg for us to give you your mortgage again? I don't get that either. Is it also the case in the U.S. mortgage interest is tax deductible in first home? I'm not sure if it still is. It was. It used to be. Interest on your mortgage used to be tax deductible so that you could look at a U.S. household income of $100,000, Canadian household of $100,000. The U.S. household will be living in a bigger house because they have the tax shield of the interest. They can afford more house than you could in Canada. I don't know if that's still available in the U.S. Let's see. Recent years, there's been many false alarms when it comes to macroeconomics. Yeah. How do you filter them from the true structural shifts that are actually happening? You do the best you can. You use your experience, you use your education, and you reflect and you think and you reflect and you think. And if something is just too good, if something just breaks with history and just seems too good, and there's a whole new story around it, a whole new narrative. Oh, you can't use that anymore. It's a whole new thing. It's usually wrong. It's usually wrong. So that's about all you can do. Is just again, we play a probabilistic game, and you play the probabilities. Many headlines amplify fear and bearishness, but in reality, things turn out pretty good. That is pretty much always the case. If you look at implied volatility on any stock, it has a wider distribution than actual historical volatility. I know the debt problem is a real one that needs addressing. Oh yes, but many other issues seem to me that they are just doomsdayers having the opportunity to gain attention. Yeah, well, how do you get headlines? Right? If you stand up and say, I'm with the crowd, well, no one's going to listen to you. You have to be extremely bullish to the point that somebody says, what the hell are you talking about? Let's get this person on the air. Or you have to be extremely bearish. They say, what the hell is this person talking about? Let's get him on the air. But if you say, we're pretty much where we should be, and we'll probably continue to be right here. I don't look for much excitement. Everybody thinks we're going to go up 5%. I think we'll go up 5%. No, you're not going to be anywhere. So, yeah, this is, that's the nature of having to come up with content 8 hours a day is you got to come up with content. Writing a thesis about active investors. Want to ask here, maybe someone has a free source where you can find data about such corporate events as the purchase of a company by activist investors. Find your list of activist investors and follow them. They whenever they buy anything, they have to file with the SEC. So you can sign up whatever fund that they're running. You can sign up for alerts, and every time they file something with the SEC, you get a notification. Aristotle being one of your favorite philosophers, what do you think of his proposed 3 lives: life of pleasure, life of virtue, life of contemplation? I think you see this in a lot of different places in self-help books. Is it breaks your world down into different spheres. One is health and wellness. One is success. One is the mind. One is spirit. This is where your relationships are. This is where your job and your career is. This is where you expand your mind and you explore things. And there's a lot. It forms the basis of a lot of those self-help things. I've always thought of the transition from pleasure to virtue as sort of enlightenment. You know what? Here's the one thing I will tell you about that transition. It's correlated more to age than anything else. As you age, you move beyond that. But I can't see how you can't not go through that. It's just a natural part of the phases that you would go through. One acts according to the virtues. That makes sense to me. Where I don't completely follow is a life of contemplation. Well, so how can I sort of give you context for this? I was in my PhD, I had a sociology minor, and I was in a sociology seminar, and we were critiquing Talcott Parsons and his view of the world, his whole idea of functionalism, which really was the dominant paradigm, and was, like, when we say dominant, it was the only one really at the time. And the one thing that I wanted to point out, or at least I can remember in myself pointing out, is that we see the world differently if we're sitting at Harvard than if we were sitting somewhere else. Where you're sitting depends, will matter about what you see. And only certain people, I think, have the ability for that kind of contemplation, because the vast majority won't, right? So he's talking to other like-minded people. I don't know if that really helps you in what you're thinking of, but I don't know if you're going to find, to sum it up nicely here, that fits in with what he's saying. I don't know that you're going to find a 25-year-old philosopher. That is usually a function of age and a life well lived, right? New 10K seems interesting, but I would also prefer the highlighted 10K that you share is also a great resource to learn. Maybe you could share the 10K notes to go through as homework before watching the video would be a great. Yeah, I can do that because I have to. I have to go through the 10K and highlight things first before I can even begin to make notes on them. You can't just ignore it. So I end up with a highlighted 10K. There is no way around that. I don't know if there is a way for me to post the 10K somewhere that you can then download. I imagine if I put it on my Google Drive and I just made it a shared folder, that you could get it from there. I'm not sure if the site allows me to do that because it's not my site, or what the cost would be for all those PDF downloads. There's got to be a cheaper way to get that done. I'll post them somewhere else. Portfolio construction management, a little section with the new position section coming up on implied level. Do you think you will be continuing with the old format of this section? There are some new trades coming up for portfolio construction. You just need certain context to get certain trades done. So I still have more trade setups to show you, but unless you have the setup, it's hard to show the trade, other than theoretically on a screen. But you want to actually show it. Show it in action. So there'll be more this fall. Increasing consumer debt is not the same as a reduction of aggregate savings because of bank lending. No. Banks lend out savings. You go to the bank. Here's the bank. You deposit $100. That's a liability of a bank. The bank has to hold $10 in reserves, and it can take your $100 and it can lend $90 out and make a loan. So you're not spending that 100, but somebody's spending that 90. This person then takes that 90 to their bank, deposits it. This bank has to hold 90 and can lend out 81 against it. Now, when this person spends the 90, you may say, well, what if they spend the 90? They can spend the 90 and they buy materials to build a business. The person who they bought the materials from deposits 90 in their bank, and that bank then has the $9 and can make $81 in loans. This person pays their employee. Okay, fine. The employee goes to the bank, deposits $90. This bank holds 9 and can lend 81 against it. No matter where the money is in the banking system, 90% of it, because of the reserve requirements, 90% of it can be lent out. If you don't deposit this $100 over here, this bank can't lend that 90. So that you can't then spend that 90. Let's say this 90 is in savings. A credit card company comes along and says, we need short-term borrowings. This bank will say, well, we'll lend you the 90 because this customer over here spent 90. And when this customer spent 90, whatever store got that $90 might find its way into here, right? So it's not a matter of trying to follow all these transactions. Money in the banking system generally stays in the banking system. It's usually in the banking system unless it's removed for the purchase of a brand new asset that has never been created, or unless it's for let's say you're buying something and the money's leaving the country. But usually money is usually always in the banking system somewhere. So for you to spend more than you make, you are spending somebody else's savings. It has to be. Sunday night, you mentioned your style of trading is not aimed to be day trading. Nope. I'm a student who will be enrolling in trading competitions. Therefore, I'm wondering if you had a 1 to 2 day trade, how would one run such an account? Whenever you have these trading competitions where it's over 1 or 2 days, it tends to be primarily day trading and luck, a lot of luck. So I don't know that those are really fair competitions when the outcome of those 2 days really relies on luck. That the winner of it, if had you waited one more day, might have been a massive loser, and the loser might have been a massive winner because the position just needed time to work. So these are not investing competitions. These are really day trading competitions. That's all that is, because there's just not enough time. Luck rules the day in these things. I find that it's less about skill and more, well, you got lucky, and more about luck, right? Financial modeling series, would you think it would be more beneficial if you could start a financial modeling series on the industries that are not frequently analyzed or well understood from particular early career? Not really, no. That would just make it more difficult. What you want is, you want to demonstrate the modeling process by using something that is not extremely well understood, but something that is not difficult to understand. Some companies are difficult to understand, and it just makes the job a lot harder. Too late to chase XHB. The thing is, you say, no, it's fine, and it takes a dump. You say, yeah, it's too late, and it goes up. I would say you got to make that assessment. We live in a probabilistic world. It could go up, it could go down. Is it really the case that U.S. CAD rate differentials can't get worse? What if Canada goes into a recession and U.S. stays strong? Yeah, they could get worse. But again, as the theme of this Q&A has been, we live in a probabilistic world. I got to play the probabilities, right? But is there a probability that it gets worse? Yeah. But if we always look at, is there a probability this stock can go down? The answer is always yes. Always yes. So if the probability of something dropping scares us, we would find that would be nothing, being nothing but 90-day treasuries. You say spending from debt is coming from savings. Doesn't this regard? Oh, I already answered that. Cap rate stock surpassed its record high of 62 in the next year or so. In the next year or so? Well, I don't know about timelines, but could it surpass 62? Yeah, I think so. Excuse me. I would assume, given rate cutting cycle is started by BOC, continued housing shortage that exists, and the record levels of immigration, Canada continues. Yeah, you're hitting all the highlights on that theme. How much we got to go here? Oh, I don't know if I'm going to get through all of that. Let's see if we can get through a couple more here. Closing a profitable trade Do you set aside the taxable portion? No, no. I have cash flows. I can, if I have a tax payment to make, of which if you've been following me, you know that I've engineered my exit. But if I have a tax to pay, I have cash flows from other sources. Owen got great results. Yes, it did. Sub-industry to be included in the sector, renewable. That is an interesting one. Shorting small caps will also think the Fed should cut rates. Okay, I've already explained my small cap position on that. Yeah. Tesla could actually buy GM from regulatory. Yeah, I think it could. I think it could. Waymo was a terrible experience for me, but I believe such technology will make the roads safer. I think somebody else said Waymo was really good for them. What time frame for your small cap shorts? I don't know so much about a time frame as about a market reaction. I think it was too much too soon. Drill baby drill. Trump means number of oil rigs, not volume. No, can't be. There is no regulation limiting the number of oil rigs. Companies are free to add more oil rigs anywhere in the Permian Basin they want. There is no regulation stopping them. They can do it. You may say, well, you can't use government lands. Yeah, but you can use the Permian. They could really increase the rig count. They choose not to. They're using EOR, enhanced oil recovery on existing wells, as a cheaper alternative to drilling new ones. So companies can add more wells if they want. They can add more rigs if they want. They choose not to. So drill, baby, drill. Here's more land to drill on. We're already drilling at record levels, and there is nothing stopping oil companies from adding rigs now. So, you know, it's sort of a hollow thing to say. Could reduce Russia's oil revenues, which in turn contributes to slowing Russian war machine. Of course, it takes more than 24 hours. Is this meant, like, have patience? Trump's not even president yet. So how much patience should I have? Olympics, nope. Arbitrage activity will most likely be higher in securities markets with no restrictions on short selling. That are efficient. Well, if they're efficient, what arbitrage opportunities would you have with high information acquisition costs? I'd probably say with no restrictions on short selling. If you have restrictions on short selling, arbitrage is going to be difficult because it requires being long and being short. If you can't be short, how are you going to arb? Right? It is explained in your videos that with less restriction, the market would be more efficient. True. Thus, I ruled out A and B. The arbitrage would most likely be higher in securities markets with no restrictions on short selling. Yeah, it would. That are efficient. Well, you can have no restrictions on short selling and still have an inefficient market. So, are you planning on doing a financial modeling tutorial next month, beginning September? Can you talk about how you decide to put a stock in a theta bucket versus an income factory bucket? So it's kind of the same thing, really. An income factory is just saying, hey, listen, I have this stock that is in my theta sleeve, and I find that I've been doing it every month. It's traveling in this pattern that allows me to do it every month. Then great, okay, let's just use that. Let's get a bit more algorithmic with it then, and put it on a system where you could, I guess, program it for autopilot. Why is there an emphasis among investors on the 50 and 200 as opposed to, say, 10 or 100? So there are some you have to think about the days, right? There are only, when you look at a 200-day moving average, it's a 200 trading day moving average. Same with the 50. It's a 50-day trading as opposed to 200 past days, because obviously there is no Saturday or Sunday in these things. So if we think about a month is usually about 21 days. So if we were looking at The 50-day, it's like, not more than 2 months, but not quite 3. I don't know. Trying to find logical ways of putting this out. It's sometimes things are just convention, of why things are the way they are. They're just convention. I think somebody, much like somebody who really, really bought into the God thing, could recite paragraphs from the Bible. Find somebody who really, really believes in lines on charts, and they might give you a reason why their group believes that 200 or 50 makes sense. They're the big common ones. But if we think about them in terms of trading days as opposed to the number of days, right? A year has 252 trading days. So you would think that, well, why not use the 252-day moving average? I don't know. It is what it is. You say lag effect from a rise in interest rates is X months. I don't say that. Fed says that. I agree that there will be a lag when interest rates go down, but would you expect the lag to be shorter than X because consumers have the ability to refinance, thus getting the benefit of lower rates sooner? Well, okay, I see what you're saying, that there'd be an asymmetry in the lag, that rising interest rates would take longer to take effect, but dropping interest rates would be faster. Okay, I mean, I can accept that it would be asymmetric, but I think there'd still be some lag effect. I just don't know what it would be. Tried maple syrup instead of cream in my coffee. Total game changer. It absolutely is. iOS versus Android, Apple versus Samsung. What are your thoughts? I don't really have thoughts. I don't use Android or Samsung. Every time I go to the keg, I order a steak. Yeah, they have fish. Yeah, they have chicken, but I order a steak. So what do I think of the chicken or fish? I don't know. Never tried it. Every time I buy a computer, it's just in the Apple family. And not yet registered at level 2. Previously purchased applied level. Currently have access to. I need to make additional purchases. Keep accessing. Nope. Looks like Kaufman sold some shares. On a quick look it would, but I left a note for you. If you look at footnote 1, for tax purposes, to pay for the share-based compensation, the company withheld certain shares to sell to meet the tax obligation. Great to jump to the paragraph and then 10K notation. I do that. In the video, I do use the 10K. I do jump back and forth from the video to the investor presentation to the 10K. Drove in a Waymo this weekend. Unreal. Company's technology is so far ahead of Tesla. So does an analyst of Truist think the same thing. Has been, taking Musk's advice of just try it, and has been trying it and saying, no, this is not robo-taxi quality. No position in ABR. I'm going to load up on the 17 calls and finance in part with 250 puts. What if the long end increases, in fact, if the Fed cuts? It's in the realm of possibility. Just for probability, that's not the probability that I would be playing. And there we go. That was a long one. All in one take, too.